Hi everybody, and welcome to today's event where we will take a deeper look into the SaaS sector, the current state of it. Just start with some practical information. You can see the program here. You can also download the program if you want to opt into different companies during the day. We will start by a short presentation where we'll take a deeper look into the SaaS sector right now, the current status of it. It will be Kasper and Antti who goes through both from the Danish side and the Finnish side, and we will try and take a look into it. Some of the findings we have put out in a SaaS report, down but not out, and no doubt about it that investors haven't loved this sector right now, but let's take a deeper look at it and maybe try to make a better understanding of the sector right now. Afterwards, we will hear from 10 companies that each will make their presentation of their own company. The event will take around 25 minutes, including a Q&A, and then there will be a short break where everybody can take a cup of coffee if you want to opt in for everything, where we will put a new presenter on the stage. But for now, Antti, I think I will hand the presentation over to you.
Wonderful. Thanks, Michael. So to start off, I wanted to share give you a lens into looking at SaaS companies, because they're quite different in terms of how the numbers look compared to other companies you might see in the stock market. So on this page, we have an imaginary software as a service company and how their figures look. So easily, when you look at one of these companies, you might look that, hey, this company is now doing neutral profit, not generating a lot of cash for the owners. You might think that it's a bad and a low margin company. But in reality, there's actually two separate businesses within this company. So if you look to the right side and the current customers part. So within each SaaS company, there are the existing customers that are generating high margin cash flows to the company. And it doesn't actually take a lot of people usually to operate this part of the business. And that part is usually very profitable. But where then the profit disappears when you look at the top line is then the new customer acquisition. So these SaaS companies, they invest in customer acquisition. They invest in expanding their product so they can grow their existing customers. And typically, they can do this at a pretty good return. So for example, in this company example we have on the page, the payback for every euro or krona invested into customer acquisition and would pay itself back in 2 years. Now, so on the surface, we see a bad and a low margin company, but when we look deeper into a SaaS company like this, we actually see that it's a compounding company that is reinvesting its cash flows efficiently. And this is really important to keep in mind with these companies, because they are mostly in a growth stage. The cloud markets are growing, and lots of these companies are investing a lot in their growth. Many of these companies are now not generating a lot of returns. And the cash flows that the investors really paying for are 5-10 years out, mostly. But it's important to understand this dynamic that actually inside the good SaaS companies are really efficient compounders. And this is something that often is disappearing under the top level of looking at the figures. But keep this in mind when looking at the SaaS companies, and we'll also reflect a bit on this in discussing how these companies are valued.
Perfect. Thank you for the introduction, Antti. I will just provide some insights about the SaaS report that we published a few weeks ago. And why not start with the question and answer this question, why invest in the software as a service sector? First of all, you can say that the business is also something that Antti mentioned between the lines, that it's a scalable business model with two growth engines. SaaS companies can upsell and cross-sell to existing customers, but they can also win new customers in new markets. And there's basically no geographical boundaries for software. Of course, there's some language and so on, but it's easier to scale across borders. We also see the recurring revenue increases visibility for investors, of course, also for the companies. And this is something that can be measured and monitored by the low churn rates for the companies. If these companies report it, it shows high stickiness. This is also included in net revenue retention rate, which most of the companies are reporting. And if this is above 100%, then they increase the existing customer portfolio. If these metrics are not familiar to you, we are commenting on the metrics and how companies are reporting it in the SaaS report. So you can find it also on our website. If we are moving our focus away from the business model and the companies and more to the sector as a whole, we see large tailwinds coming from both digital transformation, automation, artificial intelligence, and of course also optimization of resources. Of course, these buzzwords, or you can say secular trends, are kind of interconnected, but this has been accelerated from the pandemic. And talking about growth rates and the sector, Gartner, the research company, estimates that the global SaaS market will grow by a compounded annual growth rate of approximately 17% towards 2023. And this sums up to a market value of more than $200 billion in 2023. But talking about all these growth rates and high double-digit growth rates, we have seen a shift in the stock market when valuing these companies, because growth is not weighted above everything else anymore. Before, we saw that growth rates have been highly correlated with valuation multiples. More than 50% explained the multiples. However, of course, growth requires some capital that has to be invested in growth activities. And with the current market conditions, things have changed due to the increasing interest rates and also, you can say, the general market uncertainty. So right now, it's very expensive to attract and raise new capital for most companies, especially the smaller ones. So cash positions are now very important, and investors should also, of course, as always, but to some extent more now, look at the capital efficiency ratios, such as the free cash flow over new ARR or sales over a period, or you can say free cash flow. Maybe it's the cash burn. So let's take an example that you're burning 30 million DKK and you gain 10 million in new ARR over a period, then the ratio would be about 3. And this ratio might be high in the beginning, and then as the company matures and be more capital efficient, then this ratio should decline over time, and the company should be more capital efficient. Of course, this is dependent on the maturity of the companies, and I will also give you some insights about the Danish SaaS companies, which are primarily more in early stages than most of other SaaS companies are, for example, in Finland, but also of course in United States. In Denmark, the median annual recurring revenue ARR is less than 20 million DKK based on the 2021 numbers. So overall, we've seen this shift away from growth. Of course, growth is still important, but we now have more focus on profitability and cash flows, and this is also seen from the larger US software as a service sector, which are valued more on their cash flow combined with revenue growth, so the so-called rule of 40, and not only from their growth rates. Talking about you can say the shift, looking at the valuations, we also see a large shift. We have kind of monitored or looking at the global SaaS sector and the Danish SaaS sector, and using the SaaS Capital Index for a simple multiple to show how large the multiple have, or how high the multiples have been last year compared to now. We would just say that, of course, these global SaaS companies are very large, late-stage billion-dollar companies, so these are more stable than comparing with the Danish ones. But overall, we see valuations peaked last year in 2021. And as shown here, the graph tells us that the median ARR multiple was about 15 times. And this was primarily driven by a huge capital inflow from the low interest rate environment, but of course also the increasing focus on digitalization from the changing working dynamics, increasing the growth rates and the demand for the digital tools. So overall, we see that the ARR multiple for global US listed companies is back to a pre-COVID level. We will discuss this later, whether this is cheap or not, but we see a huge multiple contraction, or we have seen this over the past 6 to 9 months to the current valuation of 8.3 times ARR end of May. Comparing this to the Danish sector, I will just provide some insights to the Danish sector before we're going into that, because before 2020, there was basically only a handful of Danish SaaS companies. However, the sector was kind of built up during 2021 with many IPOs, and currently our SaaS HC Andersen Capital Index consists of about 19 business-to-business SaaS companies, and most of them, about 14 of them, are classified as, you can say, pure play SaaS, with at least a very high proportion of the revenue being software usage or subscription and not just consultancy services. What we see here in Denmark is that, of course, the growth rates are higher because these companies are from lower stages or from earlier base and scaling up the organization, but they are also more dependent on the capital increases and raising new capital because they are burning much money to scale up the organization and invest in further growth activities. But similar picture here, looking at the valuation multiple, it has been more than 15 times in mid of last year, and now it's only 6.6 times ARR. So of course, this is also a bit lower than the US SaaS sector, justified by, you can say, a liquidity in Denmark compared to the large US SaaS sector, but also you can say the larger companies have less risk than the smaller ones in the current market conditions. Yes, I will hand over the word again to you, Antti, providing some insights about the Finnish market.
Thanks, Kasper. So exactly as Kasper said, we can see some of those valuation trends in the Finnish SaaS company valuations as well. So we have the Finnish SaaS sector that we're covering at Inderes here now in the pictures. We're comparing revenue multiple to revenue growth percentage, and then on the right side, revenue growth percentage and the profitability. So what we see is on the left side is that the revenue growth alone is no longer so strongly linked to the valuation multiple. Now, during the last 2 years, there was a lot of emphasis in the market on the growth, and it was not that important to be profitable at the same time. But now with the market uncertainty, it seems that investors are putting their eyes now to closer figures. So what is the company making right now in terms of cash flow? What is it making next year? And really what the kind of growth at all costs mantra seems to be now seen as more risky. And what this means is that the SaaS companies that are investing heavily upfront and are maybe still cash flow negative, they are not in such a strong position as they were 2 years ago, because the market is now seeing the risks in these companies. Are they going to turn profitable? When is that going to happen? And do they need more capital? But still, with growth and profitability combined, we still see a clear link to the multiples. And as I said, last 2 years ago, it was enough to be very good on the growth side. Also, profitability played a part, but now it has turned much more to profitability and growth combined. And really, if we look at the profiles of SaaS companies that are maybe doing the best right now, they're the ones that are already cash flow positive, do not need to raise new capital to finance their growth strategy. And especially the ones generating stronger cash flows seem to be earning the highest multiples in the market. So really, the market is kind of in a more risk-averse point of view right now compared to what it was the last 2 years ago, at least looking at the handful of Finnish companies in the SaaS sector.
Perfect. And I would just very short sum up from our headline from the SaaS report. It's down but not out. And where are we now? So just to sum up before we go into the discussion and Q&A, I've seen some questions already. We have observed that SaaS share prices are down about 50 to 80% from the top, and some of the COVID winners and high-valued companies are even more down right now. So, however, we've seen the median last 12 months growth rates in the US being quite stable at approximately 25 to 30% in the past 6 months. So the growth has been somewhat stable, but we see that the growth outlook is now lower, and of course not accelerating from the beginning of the pandemic like we saw into the 2021, but now it's more, you can say, being more flat or even lower for some companies. So the question could be right now, so are the multiples and the current valuation low right now, or is it cheap? If we look at the median revenue multiple, it's now about, so next 12 months, it's about 6.2. And Jimin Ball, who has provided this clouded judgment update, says that about the current revenue multiple is 44% below pre-COVID levels in February 2020. It's 20% below a 5-year average before COVID, and it's 6% below the lows in March 2020. So this, you can say, tells us that the valuation is at least at some kind of low point compared to this analysis and what the levels were some years ago. You can also argue that digital adoption after COVID supports that valuation should be above pre-COVID average. However, some things have happened with the interest rates, of course. So if we are looking besides the interest rates, this logic makes sense. But of course, there's a new factor here coming from the macro environment that is more hard to predict for investors, because the interest rates, of course, is a kind of problem for the current valuation and has started this negative trend in multiples. But from my side, I think that if SaaS companies fulfill their growth and profitability expectations over the next few years, and we're not in a recession and so on, I think current levels may be a good entry point. Also looking back and comparing the multiples with the years before the pandemic and so on. So yeah, I think that's maybe that could be a kind of a starting point for our discussion. So let's take a discussion and some of the Q&A questions.
Yeah, thank you, Kasper and Antti. I think the first one we always also discuss when we sit in a group. Many companies say they are a SaaS company, but in reality are only partly SaaS. What is the best way for an investor to recognize the true SaaS companies, and is it actually important? And the ARR multiples, or ARR, is that being misused? We have that discussion. So a very good question. I don't know whether, Kasper, you would kind of give some insight to what maybe you could define as a SaaS company to look after afterwards.
Yeah, so of course that's a very good question, and all companies are different in the ways of providing software as a service. But you can say a pure SaaS would be a kind of a subscription-based model, of course, where you have the subscription payments, and most, at least we define it pure play as about 50% of the revenue being at least from the subscription part of the software. But of course there are some different models. We see that some are usage-based. So are they really SaaS companies? Of course, that could be a discussion point, but we think it's still a software which is provided as a service. However, of course, the business model and how the payments are being paid, that differs between them. There's also something about, you can say, the ARR, the annual recurring revenue. That's a key point here. And if you just deliver a software and install it on premise, then it's not a software as a service. Like it's more like a one-time installment, right? And if you provide it as a service over years and you have the same customer over years, then you can say it's more like a SaaS. But of course, some of the companies are also having two legs and some consultancy services and some software as a service. And then you have to dig into the numbers and follow how much of the companies or how much of the revenue is reported as a software as a service or ARR model. I don't know, Antti, would you add something to that? Have you seen some difference in Finland?
Yeah, I'd say the best way to look at it, or easiest maybe from outside in, is to just take a look at the share of revenue coming from different sources and try to see how much of that is actually coming from recurring parts and which ones could be, for example, one-time licenses or services. Now, I mean, all companies, like the best SaaS companies as well, they typically have a significant share of services as well, because you need to start the use of the SaaS software. So you wouldn't expect something like 90 to 100% SaaS revenue from these companies. But I'd say anything between 50 to 95 is something you can see in the market. So it's good to dig into the numbers and see where the revenue is coming from. That typically gives you an indication of, is this company really a SaaS company, or are they, for example, transforming into one, or are they just saying that this is what we are?
And if I should kind of give my insight, I think it's actually a discussion we don't need to have. If you have high net retention, if you have low churn, if you have a stable income, we can have the discussion about usage based or subscription based. Subscription based should have a higher valuation, but consumption based or usage based actually also can have a higher growth rate. So in a downturn economy, you should put lower value to that. In an upturn economy, you should put higher value actually maybe to a usage model. So actually I think the most important part is actually looking at all the parameters that gives you the kind of the business case. And I know it's a little bit of a question that can fit all, but if all the parameters are correct and the business model fits and is driving good returns on their investments and so on, and you can see that on the parameters, I don't think it's not that much of a we don't need that discussion. Sorry. Then there is a question here: is raising new capital for SaaS companies only possible if you target one investor as a problem? Is it possible to ask broad public to buy new shares in the sector right now? I don't know whether Kasper, you will kind of what do we feel right now about whether it's
so currently we see that you can say the private placements is kind of the only way that you've seen recently from the Danish SaaS sectors or SaaS companies raising new capital. So they have maybe one or two cornerstone investors or large investors that are injecting more money into the company and raising the capital. So they kind of it's very hard as the question was asked about. It's very hard to ask for money right now in the broad public because they are not that high interest currently. It's mostly coming from like the larger institutional investors or some of the larger cornerstone major investors in the SaaS companies in Denmark at least.
And how is it in Finland, Antti, or are they further away and don't need to raise that much cash? So
yeah, I tend to I agree with what Kasper said. In Finland, we don't see a lot of these challenges because the companies indeed are mostly cash flow positive or neutral already. So the problems are not that imminent. I think the challenge is that to invest in a cash flow negative SaaS company, you need to have a really long perspective. And as Kasper said, it might be easier to find that perspective from a private individual investor outside of the kind of existing shareholders. So right now, probably that would be the easier way for the negative cash flow companies to get growth capital.
And I think I kind of agree, and I will allude to the same point as you say, Antti. Right now the numbers, the payments that public markets are willing to give is lower because some of at least in the early stage, because they need a better understanding of the business model. What is their advantages? You need a deeper dig into than just buying a multiple, which was what we did in 2021, and that kind of actually puts it more to that it should be that the next capital raises will be primarily to maybe larger investors that can actually put their time in to understand the business very, very deeply. Is there a general trend in churn rates? How does the churn rates influence valuation? Are we seeing any general trend in the Danish market? Do they hold up those very, very low churn rates that we have actually seen the company go on the stock market? I know it's early stage, Kasper.
Yeah, so in Denmark we can at least track most of the companies because these companies are reporting churn rates. So of course, this is something that we are following, and I think from the report I found that the median churn rate was about 5 or 6%, and this is actually very good. So theoretically, a 5% churn means 20 years time of your customers being in the customer portfolio. So that's great, and I haven't seen any shift in the churn rate yet. So, and I think that's very important because, of course, this is some of the part of the recurring revenue that if the churn rate is maintained at low levels, then you still have this high stickiness of the software, and of course low churn rates will also affect the valuations in this part, you can say.
And how about Finland, Antti? Are you seeing any shift there? It could be the first indication, that companies are looking at their cost and also software cost, that it's the churn rates you are seeing it on. But how are you looking there? And I don't know how good the Finnish companies report that number.
Yeah, it's not too widely reported, but I'd say on the high level, there is no big trend seen. Of course, there are individual differences in some companies that got some COVID boost. So remote work, organizations buying their product and then moving away from those products now that things move back to physical. In some of those cases, we have seen a spike in the churn rate. That might have been a significant one. But I'd say that would more be a temporary one. And the overall trend is still quite stable.
And then there was also the question, how important is it for valuation, as a single number? I don't know whether, Kasper, you will give us that, it's the net retention rate that is the one really, really also important, right? But I think understanding the churn rates and looking at it, I would guess you would call pretty important for the valuation, because it's what supports that gives the two-sided growth engine.
Exactly. Yeah, so you answered yourself, I think, Michael. The high stickiness and also you can say the product market fit. If the churn rate is remained low, then the software is proven, you can say, for the customers.
Yeah, I think in my point, and now I'll ask you, Antti, I know they don't report on it, but I guess they report on net retention rate. It is the single most important number to understand whether the business model works, whether you can throw money into growing and such stuff. I don't know whether you see otherwise, Antti.
Yeah, I think that's the case. I mean, if the churn is unreasonably high, let's say 10%, 15%, of course, that would be worrying, even if the current customers as a whole were growing very fast. But I'd say overall, the most important metric would be how much is the current customer base growing overall, including the churn and then adding on top the expansions made by existing customers. And as we discussed earlier about the valuations, growth is it's a part of the valuation equation. So whatever comes on top as a whole is then what's driving the valuations.
Perfect. Thank you, Antti and everybody. The next on the floor will be Maps People. Indoor navigation, getting the most out of your square meters and your footage is kind of the high level mission. So we will take a short break and return with Maps People.